here. Hey, Matt.
Hey, how are you?
All right, I'm good. I'm good. How are you?
I am well. How are you today?
Good. So we're bringing technology to us.
Yes, our maiden voyage.
Right. This is our maiden voyage, so congratulations. So we have a couple people on. I figured we can wait for a couple more people to come on here a little bit. But we can kind of get started because we can always share this later. So the main reason I wanted to bring you on here, before I start, sorry, I want to introduce, this is Matt Graham with SWBC Mortgage. How long have you been in the business, Matt?
Just about to start my 15th year.
Wow, you're getting old.
Yeah, absolutely.
All right, awesome. So I've used Matt quite a bit in a lot of my deals. I do have a list of preferred vendors, I like to call them, for everything, right? So, and he's one of them. Not to say he's my favorite or anything, but I always can get a hold of him. So that's always nice. So that's why I invited you on here today. So a little bit about what we were talking about a couple days ago. We sat down, we went over to Cafe Lola, if you haven't been there yet. So we sat down and discussed so my biggest question was, right now in real estate in Las Vegas, prices are getting very expensive. I just sold a home in the Southwest that was gorgeous, and it went for top dollar, and it had multiple offers, and people were fighting over it. And I think about my buyers, and I think about my past clients that are maybe getting ready to upgrade into a better house. However, when we're looking at them, some of them are out of their price range, and some of them that are in their price range need a lot of work. And then I have those clients that want to look at brand new construction. And again, they're not getting a whole lot for their money. So my biggest question was, I know that there are loans out there that can help these people maybe get into the neighborhood that they want, maybe the floor plan that they want, but maybe those finishes aren't there. So that's what I wanted to discuss with you today. So let's just say, for an example, if I take Mr. and Mrs. Jones and we go look at houses in the neighborhood that they want, and these houses need some work, and of course, sometimes it's really hard to see past maybe an ugly kitchen or terrible carpeting or whatever the case may be, but then the location's right and the square footage is right. So what can we do to help those people be able to afford it? Because let's just say those houses may have been on the market for 60, 80 days. We could probably get a better deal for them because they've been sitting. What can you tell me about that kind of thing?
Well, and it's all too often the case, the buyer walks in and it's the right neighborhood, the right schools, which is often the driving factor for people. But a lot of people, when they go to buy, they have enough money for the down payment, and that's about it. When they walk in, they see any work that not only needs to be done, but they would want done for them to feel like that's home. They feel like they're kind of shut out and they have to pass on that property. So when you ask what options there are, well, we have a few different ones. The first one's an FHA 203K rehab loan. So someone finds a house they want, they can get a good deal on it. With the rehab loan, they can go in and not only fix up what needs to be fixed up, let's say to make a house considered habitable, it's got some broken tiles or things like that, but they can put in brand new appliances. They can put in, change the countertops, even though they didn't need it, but it's just something that they would want. So basically, instead of going and overpaying for a new build that might be 25 or 30% higher than a similar resale, they can go in there and maybe put 5 or 10% of that cost in upgrades and make the house the way they want it. Plus, they'll already have a finished and mature backyard, which you don't get with a new build, and window coverings, anything you want, basically. The kitchen always sells, and that's usually a big item for most buyers.
It's expensive.
And it's very expensive for somebody to not only if they're going to pay for it out of their pocket, but a lot of times clients will close and then they'll end up going through a Home Depot or a Lowe's, and they might be paying 10, 15, 20% interest on those.
On a credit card.
Yeah, on those rehab items, whereas with this, you're paying in the 4s right now on those rehab loans. And so you go in and you find a property, and we'll just use some round figures. So someone that's looking, maybe it's a first-time home buyer, and they're generally the ones who are on a shoestring budget. They find a house
but they want something nice.
Yeah, absolutely. They find something at $250 that may be worth $280 when it's fixed up, and they can put $30,000 into it, and they'll only be putting 3.5% down of the purchase price of $250 plus
And
the
that's on an
repairs.
FHA
Yeah,
rehab.
203K, yeah, rehab. And so they'll be doing 3.5% of the total. So you have your down payment of only 250 plus the 30 is 280. 3.5% of that comes out to $9,800 would be their down payment on that. Instead of putting the 3.5% down on a 250 property and then borrowing a bunch of money, or if they do have the money, depleting
like 22% interest.
Yeah, absolutely.
Right, because I know a lot of my clients, including myself, you know, you go into Home Depot, you talk to the kitchen designer, you talk to, maybe you need new doors or whatever the case may be, and they make it so easy. They're like, hey, come use our credit card, we'll give you 10% off of your purchase. But then next thing you know, you're fine print, you're paying 23-24% interest for, I don't know about you, but it takes me forever to pay off a credit card.
Yeah, absolutely. And it's just easy to just pay those minimums, whereas if you put it in your mortgage, you're just going to pay it off with your normal stuff, and you'll be getting a good interest rate on it, and it's part of your mortgage interest. You know, consult your accountant, your tax professional, but it's
Right.
it's generally deductible. And so the big thing is you get the house exactly how you want it.
Right. And that was important to me.
You know, that's the big key, is you get to decide. You see what the value is going to be after it's repaired, and you just put your wish list together and you pick and choose what you want done, and you get the house exactly how you want it, and you'll end up with a bigger lot, because it seems like these lots are just getting smaller and smaller.
They sure are.
On the new builds. But if you can go into an older, more mature neighborhood, you can get the big yard, and you can update the house to where, you know, on the inside you're living in a new house, and on the outside you get the benefits of an older neighborhood.
Definitely, definitely. Now, so how does it work exactly? So let's just say I found a $250,000 house for my client. And let's just pretend it was, you know, that was what we settled on, right? Found something that was 250,000. I know that based on like the quality of the finishes, maybe it has tile countertops, maybe it has ugly carpet, maybe it needs some major work in the kitchen or bathrooms. So we find this little house that I know could comp out it higher for my clients, and we go ahead and we say, okay, Matt, let's put this together for a rehab loan. So what happens next? Do we have, when we're in escrow, does the appraiser come out? Like, how does that exactly work?
Yeah, so there'll be they'll have a contractor that's, you know, a licensed contractor that's going to do the work. They'll actually, before the appraiser comes out, they're going to make a list of items that they want to have done.
So and then the client chooses their contractor. Yeah,
they do have to be approved through us. We'll have, you know, we want a contractor that's got a great record. We're going to want some references from some of their past clients to make sure that somebody's going to get taken care of. But they don't have to use just, you know, who we say. They can refer someone to us, and we can get them approved in short order.
Oh, perfect. Okay, great.
Yeah, absolutely. So they'll get the bids, and the bids will go out to the appraiser once the bid is in, and then the appraiser is going to do what's the home worth now, and then he's also going to give you an after repaired value of it, and that's how we set up the whole rehab process. So they can go up to that after repaired value, and they can actually go a little above it as well, depending on what they want to do. And like I said, some of the items are, you know, just wish list things. So like if you had $4,000 or $5,000 worth of appliances, you're probably not going to get dollar for dollar on that on the after repaired value. But that's where obviously your expertise in negotiation comes in.
Always. So let's just say we buy a house at 250,000. The contractor comes out and says, hey, for a new kitchen, a new bathroom, new floors and paint, it's going to run you 30 grand, right? Again, don't quote me on these numbers. I'm just throwing out an easy number. So now 250. So now we're at $280,000. So when we go through the process for the escrow, the appraiser comes out, they appraise the before and after value. And let's just say the appraiser says, yes, the house will be worth $280,000 once the work is completed. So now the client is getting $30,000 towards these repairs. So what's the next step for them?
Well, we'll go through and we'll close the loan just like we would any other loan. And at close, you know, those escrow monies for repairs will be put into an escrow account, and then the work will get started. And the contractor will get paid out of those monies, you know, a little up front so they can get started for materials, a little more when they're halfway done, and the rest at completion. And then once they're completed, the appraiser comes back out, an independent person, to verify that all the work's been done. It's been done in a workmanlike manner. Client signs off on it. Everyone's happy. So we'll close these in maybe 5 to 7 days longer than normal transaction. They don't take that much longer because the work is done afterwards.
I see. Okay. So what you're saying, because right now, my average close of escrow date for my clients, usually it ranges anywhere from 25 to, I don't know, 25 to 45 days, right? Depending. And that really depends on, we can close them usually. I know you can close them for me in 25 days, 30 days. Sometimes they take longer only because maybe the seller and buyer agree to a longer escrow, whatever the case may be.
Sure.
So what you're saying is, let's just say we write an offer on a property and we're proposing a 30-day close for a regular deal. So with you, since we're going to be doing, or with this kind of loan, we should probably add that extra 15 days on top of it.
35 or 40 days is really plenty.
Okay.
We can get them done faster, but a lot of this is all about the client being comfortable during the process, because often, you know, this is a new process for them. It's going to be their first rehab loan. For some of them, it's their first loan. They might want to take a couple extra days with the contractor, getting the bids done, making those decisions. So if you gave me an escrow of 30 days on one of these, we could absolutely perform on it, but having 35, 40 days.
It's better for the buyer.
Yeah, it's better for the client, better for their experience. And in the end, that's all that matters.
Okay, perfect. Yeah, because I know right now, especially in the market and especially in Vegas, and I'm sure this really applies to other areas of the country as well, you know, home pricing is just getting more expensive, and renovations are getting more expensive, and everything's getting more expensive. So to be able to find something, I know myself, like every so often I go on the MLS and I'm playing around. I'm like, yeah, let's see what's out there. Yeah. And it just shocks me sometimes, the prices of these homes that are selling for, that need a ton of work even. And they're just not moving, because I think that, you know, people have a false sense of what the value is or whatever, what have you. So great. Now, you know, you mentioned this 203K is for an FHA loan. Does the buyer have to go FHA, or can they go conventional?
Yeah, we have a conventional version, the home style rehab loan, and that allows them to go into a little higher price point.
Okay.
And with the home style, with the FHA version, you can only do pool repairs. With the conventional version, you could actually, if the value was there, you could put in a brand new swimming pool as part of it. So
seriously,
and that's always nice. And so
that's cool.
Yeah, sometimes that's a deal killer. You know, I have to have a pool. They find everything right, the right neighborhood, house, floor plan, the house is turnkey, no pool in the backyard, and they're like, well, I don't have 30 or 40 grand to, you know, to put out. And so if the value's there, they could actually put a brand new swimming pool in a home as well.
That's fantastic. So they could really go, let's just say somebody wants to live in South Summerlin. They go out there, they find a little fixer has everything they want, maybe except just doesn't have the pool. Make an offer with this type of loan, close the deal in 30 to 45 days, have the contractors come out, start working on it.
Yep. As soon as they're closed, they can get started on the work.
Beautiful. So they'll get their keys. So the trick is, to everyone that's watching, is if we close on the loan, you're going to get the keys to the house, but you're basically going to hand them over to your contractor, unless you're planning on living in the house during the work, which I don't know. So if you're renting or if you're selling a home, in order to qualify for another home, right, you will need to find we'd have to figure out if the buyer of your home is willing to do a rent back, or find you a short-term rental where families stay with, or what have you. Or if you are renting, keep your rental for a little longer if you can afford it. Cool. I think these are awesome. Now I see we have a bunch of people watching. So hey everyone, thanks for joining us. If you have any questions, please feel free to type them on here. I know we went over a lot of information. I hope we covered everything. And even after this broadcast is over, if you have questions, feel free to go ahead and put comments, and Matt and I will be happy to answer them. So I'm very, very excited about this. And the funny thing is Matt and I met a few days ago to go over other things, and then I kind of brought this up, trying to find solutions to some of my clients, because I know with the new homes, especially, I have clients going in there, and I've sold a lot of them, and I love them. But it's funny, personal story is, when Brian and I were actually looking at new homes several years ago, back in 2007, we were looking at brand new homes. We were going from builder to builder. So we'd walk through these homes. I'd fall in love, of course. I'm like, yeah, look at these kitchens. Look at these. Oh, this is so beautiful. And next thing you know,
Upgrade.
the lady comes in and she goes, oh, you like the house? I'm like, yes, this is so gorgeous. I like the house just like this. She goes, oh, that kitchen is extra. Oh, those floors are extra. Oh, if you want these high countertops, they're extra. If you want these nice cabinets, that's extra. And my mother-in-law and I, well, she came one of the times and we were joking about how like, oh, do you think these walls are extra? You know, because it was like everything was extra, extra, extra. And by the time you know it, at the time we only had like a $220,000 budget or whatever it was. By the time we added those extras, the house was $325,000. We're like, okay, I guess we'll just take it bare, you know, basic B if you want.
Yeah.
and it was a great house, like we loved it, but you know, I always, you know, I wished I had the nicer counters and nicer this, nicer that, and I'm sure these loans were available then as well. I'm assuming. But
yeah, they aren't available on new construction though.
No, but I meant like,
but yeah, they were.
Had I known, like, let's just say these loans were available back when we bought that house in 07.
Yeah.
God, that would have been great. You know, Brian and I could have bought something in the neighborhood we wanted, because literally our backyard was, if any of you been to that old house, 10 feet long or wide and about 25 feet wide long. No, I'm no joke. We couldn't even put a little like gazebo back there because it was so small.
Wow.
So this is fantastic. I'm glad to hear it. Does anybody have any questions while you're watching? If not, again, like I said, we can post. Do you have anything else to say, Matt? I feel like I've been talking.
Yeah, one of the things, and you kind of brought it up there at the end with the FHA version of this loan. These loans are very popular back east because a lot of the homes are older and actually require to be considered habitable. I see Patty's got a question, so let me jump to that. Are there any restrictions on what kind of remodel can be done? Patty, no, actually, other than there's a couple different versions, but they go as far as you can actually do permitted work that's needed on one of the versions of the FHA loan, and the other one is just for normal remodel stuff. But, you know, it can be flooring, it could be baseboards, it could be new paint, it could be a whole new kitchen, you know, pool repairs. There's even some landscape stuff that's allowed, and of course, you know, brand new appliances. So basically, the whole gamut of what you need on your remodel. So, but with these loans, if you do find a house that, let's just say, is in terrible shape, one of these ones that's boarded up, let's say, FHA will actually allow you to finance in up to 6 payments if you're not going to be able to move in for a while. So now you're not paying rent and a house payment. So if you had to stay in your rental,
so they'll defer your payments for later?
They'll include your up to your first 6 principal and interest payments in the loan.
Oh, that's amazing.
So that if you're doing a gut, you know, just right down to the studs and redoing it, you can do that. And that you know, and back east, that they need to do that a lot just because of weather. So there's 3 or 4 months out of the year, there's not much being done. If there's any outside work being done, there's snow everywhere. So they've got that built in. But out here, you find a house that, you know, had some severe damage, was just left vacant and it's been vandalized. You can gut the whole house, and you're not, you know, you're paying for it, but it's just put in as part of the loan. So you're not making a rent payment and a mortgage payment or 2 mortgage payments at the same time.
That's fantastic.
Yeah.
So, because I know I've taken clients out to see homes and it was the perfect house, but they were going FHA and it had no floor. And we're like, you can't close something without a floor unless I go out and buy a floor, put it in, you know what I mean?
Yeah.
This is great. And I didn't realize you can actually finance those payments if you can't actually live in the house, because that's a big deal too, because not everybody has the money to start making payments on a mortgage and then also pay their rent. So that's awesome. So we've been talking about new homes, or not new homes, but somebody buying a house to do the work on. Let's just say you are in a house currently, and let's just pretend I live in this house and I want to sell it, but I know if I put like 15,000 into it or 20,000 into or whatever, I could probably get more money for it. At the very least, it'll sell much faster because I'm competing with other nicer homes in the neighborhood. Let's just say. So, and I know that I won't want to sell it in the future, or maybe I want to even stay in it and not sell it. Are there those type of loans available for those people as well?
Yeah, it's available on a purchase or a refinance. So if you're looking to just refinance, and it's, you know, I like this to do it this way with the refinance, because if you just do a cash out refinance and take $50,000, you know, we're Americans. We find way to spend money.
A new
And
car.
yeah, things that might not be the best use of those funds, but if you do it through the rehab, let's say you start with a budget of 40, but you only ended up using 35 of it, that whatever money is left over in that escrow account goes towards a principal reduction on the house. So you don't spend any money you don't need to. You don't waste any money, or money finds its way out for whatever, you know, like you said,
Perfect.
a new car.
Basically, if you take out 50 and you only lose 35 of it, really, you're basically giving that 15 back, and you're not.
Yeah, it's just going as a principal reduction on the house.
Oh, cool.
Yep.
Perfect. Thanks, Patty, for that question. That I just didn't say about that, but yeah, we have any other questions before we go? I know this Facebook Live was a little long, but I think it was successful. So
absolutely, I enjoyed it.
Information. It's very exciting. Well, let's get people into the homes they want. Not have to overpay for things that are already done.
Yep, absolutely.
So if no one has any more questions, I want to thank you, Matt, for joining me today, and I appreciate it for watching. This will get posted in my stories, and I'll also post it to all of my social media. And then Matt, I'm sure you'll share it as well. And again, if anybody watching either now or even later has any questions, feel free to go ahead and comment on this video. You're also free to go ahead and private message me, or email me or text me. Matt's the man. Matt is the man. And I'll also put our information there, so if you have any questions. So cool. Well, thanks so much for joining me, Matt. I appreciate it. And I hope to do this again very soon with you, maybe on another subject.
Absolutely. Sounds great, Shirin. Have a great day.
All right, guys. Have a good one, everyone. Bye.
Bye.